Hello and welcome to 5QIQ Financial Power-Ups with Trajan Wealth, where 3 seasoned pros walk through 5 money questions from our friends at home, just like you. From navigating market headlines to making sense of your retirement options, we're here to add some clarity, not confusion. I'm Jeff Jr., founder and CEO of Trajan Wealth, and with me are fiduciary advisors Corbett and Marti Bryant. Combined together, we've got nearly 100 years, believe it or not, of financial services experience just sitting here. So today we'll pull back the curtain with honest conversation, practical ideas, and a little encouragement along the way. So let's get started with question number 1. So question number 1 is, how can I vet a fiduciary? What should I ask a potential fiduciary when determining if it's a good fit for my goals? Great question.
When you are looking for a fiduciary, you want a fee-only advisor. You don't want somebody who's what we call duly registered.
What does fee only mean, though?
Fee only means that they charge a flat fee per year. So a percentage usually, not necessarily just a flat dollar amount. It's a percentage of the value of the assets they are managing for you in the stock market.
Good question. Good point.
Thank you.
So I think the ability to also check who you're working with, as well as the firm, because there are some firms out there that operate as a fiduciary but have had troubles in the past.
They're called disclosures.
Right.
Right. Now, if you want to look for a fee-only financial advisor, NAPFA is where you go, National Association of Personal Financial Advisors. That's where you want to go look for a fee-only advisor. Or you can go to the SEC Investment Advisor Public Disclosure.
Sure. If you want to see if your fiduciary is a certified financial planner, if you go to cfp.net, you're able to look up a person's name there, by their zip code, and it'll give you a list of CFP professionals in your area.
But CFPs are not synonymous with fiduciary in the investment world. You can be a CFP and be a broker.
This is true.
So if you want a fee-only true fiduciary, go to the NAPFA.
FINRA is the regulatory body, Financial Industry Regulatory Authority. So finra.org, and then up at the top of the screen, you're going to see broker check. And then you have the ability to type in that advisor's name. And what that's going to show you is it's going to show you years of experience, what firms they have been with. So it's a abridged resume, what firms they have been with. It's also going to show if they have any disclosures, which Marti mentioned. So a disclosure, as we know, is any kind of background issue. A background issue that might be pertinent to you as an investor. Right. And it's up to the regulatory bodies as to what they disclose and not. So if they have a bankruptcy, or they have a tax lien, that's going to be disclosed. A felony, if they have any customer complaints, that's going to be disclosed as well. But it's also going to show, to another point, is if they are a registered broker and or an investment advisor. And keep in mind, they can be duly registered. And I think if you're going with somebody who's duly registered, just make sure that they're acting as a fiduciary when they work with you and not a broker. And that could be a little bit slippery of a slope. In Trajan Wealth, what are we?
Fiduciary only.
We're fiduciary only.
You will not find us literally on broker check. It'll say when you click on us, we're going to take you to the SEC website, because that's where you can find our information. I like to say that there's 2 schools of management, if you will. So what people usually start out with are investors. They invest your money. Your bankers invest your money. What we do is we manage assets. What we want to do is manage your lifestyle, help you reach your financial goals, get you into retirement, get you through retirement. And that's through the financial planning side of it, not just putting your money in the stock market. We will talk about tax planning. We will talk about all of those. When you're working with a broker or somebody who has a different label over the door, right? Like Merrill and,
Series 7 license.
Vanguard, Schwab. Yeah. They're going to say, oh, you have to talk to your CPA about that. We want to talk to you about Roth conversions if that's good for you. Well, they're going to say, go talk to someone else. We have the ability to keep pretty much everything that we're doing under one roof here.
So it's really, what services do you offer?
Yeah.
Like Trajan Wealth is an example. We've got Trajan Estate. So we have in-house estate attorneys. We also have Trajan Tax. So we have in-house tax preparation and CPAs. So we have in-house CPAs for tax preparation. And it's all in-house. A lot of advisors, they might have a relationship, but they're going to sub it out and they're going to send it out. So make sure that they're offering the services that you want. Highly recommend doing it in-house because the communication is significantly higher.
And much more control.
And much, for sure.
Yeah.
And then, also, I think it's I might be stating the obvious, but make sure you like them. You have lots of choices. I mean, there's lots of financial advisors out there.
Yeah.
If you live in any major metro, you could throw a rock and probably hit 5. So make sure that you're working with somebody that you genuinely like and they're not talking a bunch of jargon and talking over your head and talking down at you.
And they truly answer your questions.
And they answer your questions
and
thoroughly.
So, like maybe another, and the only reason I say to ask these types of questions is because these are offerings that we have for our clients. Right. So are you going to be stock market based only? Or do you offer non-correlated assets? Right? Assets that have the ability to grow that aren't even correlated to the stock market. So if you're an accredited investor, again, private equity, private credit.
What is an accredited investor?
An accredited investor, to meet the criteria of a person who we can make these additional offerings to, you have to have consistent income of the last 2 years of $150,000 or more, $200,000 or more, and or have a net worth of $2 million. And most of the time, not including a home.
Right.
But a lot of the times, people can fit into that criteria. That just it gives us the ability to create a much more robust investment strategy, wealth management strategy. Do we ask them if they use additional products? Do they use products that might earn a commission? So like annuities, insurance products, all of, just pretty much anything you can think of investing in. You want to ask those questions.
So let's jump right back into your questions for the week. So we're on to question number 2, which is, how closely should I pay attention to the market and worry about it? There is so much noise out there. How can I tell what I should do and what I should pay attention to? Great question.
It is.
We could get deep.
We could. I mean, the ability to pay attention, I think really depends on your time frame. I mean, if you're getting closer to retirement and you feel like you're taking on too much risk, then, we need to have that discussion and say, yep, maybe we need to ratchet back the risk because the finish line is that much closer compared to, say, you're 32 and you've got a long runway. The reality is if you're working with an advisor, we're going to be doing all that heavy lifting for you. So you don't have to worry about that. That's part of the reason why you pay us. But also the other reason why you pay us is to make sure that we're doing all the right things for your benefit. Because as any true fiduciary, the more you make, the more I make. So the ability to know that I'm truly on your side, knowing that we can give you a true plan that's not going to be conflicted with commissions and loads and fees, and the ability to minimize fees as much as possible to what I call reducing drag on the portfolio.
So how often should you check? Frequency, generally speaking, for long-term investors, quarterly, maybe a couple times a year. That should be sufficient. If you wrap yourself around the weeds of the numbers of the stock market, you're going to go insane.
Especially daily.
Right.
Daily, right. And the people that are like, I lost 100 today, I made 2,000 yesterday. That's not money you're making.
Right.
Are you a trader? Is that what you're doing? Are you a trader? Then go concentrate on the work that you need to fund these accounts. Don't concentrate on what these accounts are doing. Otherwise, you probably are going to be disappointed on a daily basis.
Right.
Right? It's the long-term goal is what you have to set and forget. Do the checks.
And treat a lot of this news as though it's an opinion.
Right.
Right.
Because I think people watch the news with bated breath.
Yeah.
And they get so uptight about what's going on in the news that they make the emotional decisions which impact their investments.
Bad news sells.
Yeah. Bad news sells. That's right.
Or they hear the stock market's crashing. That's the NASDAQ, the Dow, or the S&P 500.
Right.
How many indexes do we actually have?
Right.
We have thousands of different indexes. So when you hear the S&P is crashing, are you invested in an index fund with the S&P? Are you benchmarking the S&P as your strategy? Does that mean your money is crashing?
No.
Does it mean that you need to sell? No.
Especially
Not
if
necessarily.
you're going to not need the money for
A long time.
down the road.
Yep.
Right.
Then there again, that's where we talk about diversification.
Right.
Throw some money into the Russell 1000 Value Index. Probably never heard of that. So if the market is crashing and you're not correlated to the assets that they're talking about, or do you even know?
One of our questions is about private markets and private investments. We'll get to that here in a minute.
Sure.
But, one thing to mention here too is when the market is crashing, there's only about 4,600 stocks in the U.S. stock exchange. That's it.
Yeah.
Only 4,600. It's really, really small. So thanks for the question. So moving on to question number 3, how much do I need to retire? We hear this quite a bit. We hear this from clients all the time.
Daily.
And what do I need to know to figure this out accurately?
Well, what I tell most of my
Good
clients,
question.
never retire.
Right. That's the easy one.
That's the easy one. You don't have to worry about it. How much do I need? Well, if you're going to work for the whole life. But if you truly enjoy what you do, I know I'm saying that, facetiously, but the ability, do you know what that word means?
Oh, I'm sorry. I was sleeping, Corbett. You were talking.
You're right.
My
so
bad.
the ability to know if you love what you do, it doesn't feel like work.
Mm-hmm.
So for me, I love what I do. The ability to help people with their finances and come up with a plan and know that they are entrusted fiduciaries to give them what they need. I mean, that is something.
Now, what if they have to retire?
Yeah, but Corbett, we're not talking about you and your passion. So we're talking about, people
lack of passion?
people that might really want to no longer work.
Right.
So by and far, I'm sometimes surprised by this question because it's super easy. How much money are you making now and how much money are you spending now?
For you, it's super easy.
Right.
Yeah.
I know.
Mhm.
Right.
Mhm.
It is because that's what I do. But how much are you making now? How much are you saving now? So if you're living paycheck to paycheck, well, we might want to consider, and then obviously you have to take out if they're making contributions into the retirement
Right.
plans, right? Well, that's probably what you're going to need to live off of. Are you planning on paying off your debt? How much debt do you have? What do you want your lifestyle to look like in retirement? Where's Social Security going to fit in? Right? What are taxes going to look like?
Right.
And so those are questions you probably can't answer on your own. And
It's tough.
That's where you need to have a professional help you answer those questions.
So is $1 million enough?
Depends.
Depends on your spending.
What kind of $1 million is it? Is it all taxable money? Meaning, is it retirement money? Well, then you don't really have $1 million now, do you? You got Uncle Sam sitting in your pocket,
Taking
waiting,
a third.
waiting for what his is his.
And then RMDs.
Then required minimum district, and he's only taking a third if you only take a little bit out. But if you decide that you want to go buy an RV with your 401k, he's taking more than a third.
Oh, yeah.
If you're taking out $500,000 for an RV in 1 year,
That's expensive.
I know I've heard quite a bit about the 4% rule when it comes to taking withdrawals from investments. What's the 4% rule?
So a 4% rule goes back to what they kind of call the pension rule, to where if you only utilize a 4%, what's called drawdown or withdrawal rate, you should never run out of money. Because in theory, if you have a good diversified portfolio, you should be growing about 7.5% to 8% net of fees. So if you're growing by 8 and you're taking out 4, in theory, you should still have a 4% growth.
So what number did that used to be a number of years ago? Not too long ago, like about 10 years ago.
5%.
And then probably about 5 years before that, or 7 or 8 years before that, it was like 6%, 7%.
Right, because the interest rates were higher. So
Right.
you could afford to invest in bonds because the interest rates were higher compared to now. The traditional 60-40 type of retirement portfolio, 60% stocks, 40% bonds, that's okay if that 40% of the bonds is kicking out enough income to really satisfy your lifestyle.
So now what I'm getting at is, 7-10 years ago, things were not as expensive as they are now. So that $1 million portfolio you had used to be able to draw down $60,000 a year.
Right.
Now that $1 million is only $40,000 a year.
And what's really scary is there's even some talking heads on the radio that's saying to expect 12% per year. And you can expect that by putting it into 4 mutual funds. You know who I'm talking
That's Tennessee
about.
again, right?
That's incredibly scary.
Yeah.
Very
it's
scary. But it's setting the wrong expectations.
It is.
You know,
It is.
oh yeah, you're going to get 12% a year with 4 different funds, growth in income. I mean, come on.
international.
Like you mentioned 8%. So 8% is a realistic expectation.
Right.
But not every year. It's just
Right.
not going to happen.
Right.
Well, what
Nobody
I
can
was gonna say
guarantee that.
You know, the sequence of returns. It's very important.
Yeah.
Where once you retire, say, a 20-year time horizon, if you have very bad years in the first 3, compared to the inverse, where you have 3 good years in the very beginning, the person, and you're taking out, let's say on that $1 million, let's say 4%, $40,000, and if the market went down 10%, 15%, 3%, you're still taking out that $40,000 because you have to live. Well, guess what? You're probably going to run out of money at the end compared to the person who had really good years in the beginning. They're not going to run out of money because that $40,000 withdrawal is not as impacting to the overall account value.
Right. So don't ask your neighbor, right?
Right. Or
hey,
uncle.
you got a great retirement. You got all the toys. You have all the things. How did you do it? Oh, God, this is what I'm doing. Well, you're not going to have the same retirement your neighbor's going to have, even though you might have the
But
same money.
you don't know what that person is, if they're financed, they're leveraged on it, all those different
No,
things.
of course not. But that I'm just getting at sequence of returns.
Well, true.
Right.
Yeah, but
That's all I'm
also,
getting
I call them, the $30,000 millionaires. You know, the ability to have all these fun toys and all these things without really knowing that, you know, they're levered to the hilt with all this debt and really living way beyond their means.
Like right before the housing crisis,
Right.
when
Right.
everybody who
Yeah,
used
yeah.
their house as an ATM lost their shorts,
Right.
but they had the toys that they had to sell because they couldn't afford them anymore.
Yep.
Yeah, so Marty says this is an easy question, and I think it is if you know what you're doing and how to plan for it. And I'd say if you have questions still, contact Trajan Wealth because we have some absolutely fantastic software that we can punch all your variables into.
Yeah.
So here's question number 4. I heard an ad recently from Trajan Wealth about private markets. What are they, and what are the benefits?
The biggest benefit is that you are investing into something that is not correlated to the stock market. So, you know, we talk about things that are correlated where stocks and bonds are supposed to be not correlated, but over the last few years, they've become more and more correlated. I know we talked about Bitcoin in a previous session. Same thing. Bitcoin used to be much more uncorrelated to the stock market, but unfortunately now it's becoming more and more correlated. So with private markets, the ability to invest in something that's not going to be correlated to the market, something that you're not going to have to worry about volatility with it, but also the ability to get a much higher return, you know, and they call that an illiquidity premium. Now, private markets and different things are fantastic, but you do have to know what you're buying into, one. And two, you do have to realize that it's not going to be the most liquid thing in the world. You know, you're typically going to have a 6 to 8 year time commitment for it, but that doesn't mean that your whole investment tied up for that entire time. Typically, you're going to get your initial investment back within, we'll probably say 3 to 4 years, and then the rest of it is going to continue to roll and grow. But knowing really what you're buying into, whether it's, you know, some type of new innovations or an infrastructure, more income based, but knowing that, hey, I'm buying something that is not correlated to the stock market and is going to give me greater returns down the road.
So, I mean, private markets, just to be clear, are private companies, meaning companies that aren't publicly traded.
Correct. Correct. So think hedge funds. Most of the time when people think about private equity, they think about REITs, real estate investment trusts. But during COVID, they did, so some of these private credit and private equity strategies will have what we call liquidity events, meaning quarterly they might pay out some money, or if somebody passes away, you should be able to get your money back out even though it hasn't, quote, matured yet. So when you're getting into these types of investments, they are risky, and that is why you have to be an accredited investor to qualify for them, which we defined just a little bit ago. Regulation is lower on these. You know, the stock market is very heavily regulated.
Right.
These are not. So when you're getting into investments like this, you can expect to pay higher fees, but your return is also expected to be higher than that of you just went in traditional route into stock market.
And there is some historical data on that return
There
too.
is.
It's
Right.
just
Yes,
not
there
a,
is.
it's just not a hope and a prayer.
Yeah.
Right.
Yeah. So it can be, so we offer several different strategies. We do offer REITs. So I'm just one of the advisors that don't
But they're a little bit different.
care for REITs, but we offer other investment strategies.
Can we talk real quickly and pivot about the mid-market? Because that's what Trajan Wealth focuses on as opposed to the large market. Can we talk about the difference between mid-market and large market?
Blackstone being the largest alternative investment firm out there, they do a lot of different things. So for us at Trajan Wealth, you know, let's be honest, we are not Fidelity. You know, we're not small, but the ability for us to really capitalize on, like you said, Jeff, the mid-market. Because a lot of times a company like Blackstone, let's say it's a $20 million deal. Blackstone could care less about a $20 million. That is a rounding error for them on a single day. So there are a lot of opportunities in that space to where we can capitalize on that because it's small enough to where the big guys aren't going to care about it, but we're still able to take advantage and be opportunistic in different areas.
We're not talking about, you don't have to have, you know, tens of millions of dollars to get into these strategies. We forged a relationship with a company, just regular investors.
That isn't available to
that's not
any other advisors out there.
Not available at all. So we have the ability to offer, even just with $100,000. I think one of them was $50,000 that you can buy in. You still have to be accredited, but now you're not taking $1 million, $2 million, $3 million, $4 million, $5 million of your assets and putting them in this.
Right. And for us at Trajan Wealth, you know, Marty and I and all advisors are going to be very upfront. So, you know, hey, this is something that's not going to be very liquid. So it's something that, hey, if you think you're going to need this money within 8 years, then it's not appropriate. So knowing what you've got, but to give you a complete diversified portfolio with uncorrelated assets private markets and individual stocks, things like that, to where we can really build your wealth.
There's an estimated 36 million businesses in the United States. Only 4,600 are traded on the U.S. Stock Exchange. So 99% of the investment opportunities and the companies are being missed out on by the average investor.
Right.
And that's what private markets are. So if you're interested in private markets, highly recommend contacting Trajan Wealth, one of our fantastic advisors, because there's a lot of opportunities out there. So let's move on to question number 5. And since we're coming to the end, I think it's perfectly appropriate to talk about estate planning a little bit. So let's discuss estate planning. Should I add my kids onto my bank account or the deed to my house before I die?
Yeah, let's give away that appreciated asset and give it to the kids, or add them to that asset so they miss out on the step up in basis. Why would we want them to have anything advantageous when we die?
True.
Yeah.
If you
Or my
want to punish
stock.
them, if you want to
Right.
punish them,
Yeah.
yes, do
Let's
that.
just give the
We've all
IRS
felt like that
more
sometimes.
money.
Right,
Let's give
right.
more money.
So the short answer is absolutely not.
Absolutely not. Absolutely not. And that's where your estate plan is going to come into play. I hear time and time again, oh, I added my kids to my bank account because if something happens to me, I want them to be able to write a check. Well, let's, pump the brakes. Let's talk about the pros and cons of that. The pro is, yeah, they can write a check. Here are some of the cons. If your child is being sued, right? They got in a car accident, they're being sued. That asset's on the table because they're an owner in that account,
Yep.
right? So when you die, cash, there really is no basis to step up for the cash. But let's say now you're on an investment account, right? Or no, we'll do the house. So now you've added them to the deed to the house because you wanted to make sure that passed on. Well, if they're on the deed to the house, they're only going to get a step up in the basis to the extent that you owned the house. So if you have one kid and it's the two of you on there together, they'll get a 50% step up in basis, meaning if you paid $100,000 for the house, it's now worth $200,000. They inherit half of the house at the proportion that you owned, market value as of that day. Right. Now,
Date of death valuation.
date of death. Or if you wait until you die and it's in the trust and it says your child gets that asset when you die, they get the full step up in basis. They inherit it at $200,000.
Right. But
No
also,
taxes.
To the point where, like, say, if you did add your child to the bank account, and let's say you're having a family reunion and there's a gas leak and the whole family gets taken out, guess what? That account now has to go through probate. Compared to, now, obviously, no one wants to die, but if that same scenario happened and you had that asset in a trust name, it avoids probate and can be properly dispersed on whoever the remaining heirs are on that.
So a trust is the belt to all of your durable documents. So people come in, oh, I have my last will and testament. Well, a trust includes a last will and testament. And that is spelling out who gets what.
Trust package.
The package does.
Right.
That also includes your living will, which your medical direct, or your, what do you want to happen? Do you want to be cremated? Do you want to, be dropped out of an airplane?
I want to be put in a pod.
We want you to be put in a pod and kicked to space. Or do you also your financial power of attorney, medical power of attorney? Those are the two things that are going to satisfy your needs financially. So if you're in a coma with a financial power of attorney, that person can step in and pay your bills. You don't have to add them to your bank account. Medical power of attorney, who's going to pull the plug or follow those living will medical directives, right? So that's what a trust is going to do. We're going to re-record the deed to your home in the name of the trust. The goal is to own nothing and control everything when you die, right?
Who said that?
Right.
Rockefeller.
Rockefeller.
You can also control your assets from the grave. So if you have a child who might have addiction issues, you don't want to cut them out, but you certainly don't want them to have lump sum amount of money.
So if you're looking for the easiest way, then sure, add them to your account and add them to your deed. The best way is to have a trust and get a trust created.
Right.
And if you have questions about the difference between the two that we haven't got into today, I'd say contact Trajan Wealth, because we have our in-house estate attorneys that are more than happy to help and answer any questions that you might have.
Yeah.
So great questions, great discussions. So as you think about today's questions, remember that progress with your finances is almost always because you took a series of small, intentional steps over time. It's not just one big leap. So have a question that you'd like us to tackle? Simply head to trajanwealth.com/5QIQ and share it with us. We're standing by as always to help you plan smarter and dream bigger. So from all of us at Trajan Wealth, we wish you strength, health, and we wish you continuously stronger wealth. We'll see you all again real soon.